Hi, it's Larry McDonald with the Bear Traps Report. Craig Shapiro's in the house today. Big week. Want to recap the week. Craig runs our Discord room with institutional investors in 30 plus countries. We have a chat on Bloomberg. Join us there. Tatiana at thebeartrapsreport.com for more information, or our Discord room with Craig Shapiro. And what we're trying to do is really crowdsource information every week. Biggest hedge funds, mutual funds, and pension funds in the world are our clients since 2010. And we want to recap the intelligence gathering, every Friday heading into the weekend. Craig, first of all, in your conversations with accounts this week, seeing a big outperformance of Chinese equities versus the Qs, seeing a big move in precious metals. What are the main takeaways? What are clients talking about this week?
Hey, Larry, thanks for having me again. Yeah, look, I think, obviously it was a big macro week this week with the CPI report, a lot of Trump stuff, but no, I think you're right. I think the biggest thing we noticed this week was client interest on Chinese equities. And I know we've been talking about this for the last few weeks and months, and this has been, I think you pointed out this morning the word uninvestable, right? China was uninvestable, and typically when you get that word, the sentiment is a disaster, and time to go the other way. So we've been seeing a lot of that and a lot of interest in these Chinese names, and it really shows. I mean, Baba has been a terrific outperformer in the last few weeks. KWeb, all the Chinese internet names as well. So that's definitely been a very big theme that we've been picking up on this.
And we did a trade alert sell today on Baba and KWeb. We've been in the trade for three plus years. It's been very difficult many times, but what we've done a great job in the trade alerts. And once again, that's Tatiana at thebeartrapsreport.com. Email if you want to get on the trade alerts as a client. But selling strength in Chinese equities has been, kind of the key thing to do. And I think we sold that Tepper rally, and thank God, because we had that major drawdown after the Tepper rally in September, October. So right now, I'd be kind of paring back China risk, because at the end of the day, you still have a tremendous amount of negativity across the street. The street's still very underinvested, which is bullish for the long haul, but you've been rewarded by selling these rallies in Chinese equities. Craig, big stagflation week, slower growth retail sales, yet more sticky inflation. Our clients kind of restructuring portfolios toward that 2022 stagflation portfolio.
Yeah, we've been hearing a fair, bit more about that. I mean, basically, it seems like what we had was a pull forward of demand right when Trump got elected in November, fourth quarter of 2024. Nice economic momentum. Folks were kind of getting ahead of maybe the Trump tariffs, and now that Trump is in place, I think uncertainty is reigning again. Right? There's been more uncertainty about the tariff outlook. The tweets and the start dates, and then the delays, and then the restart, and then the delays.
And can I just mention, that's another thing with China. Trump, this is totally different than 2008, 17, 18. Trump needs $200 billion of tax revenue from the tariffs to basically pay for his tax cuts. And Craig, isn't the complacency off the charts? Like, people think that these tariffs aren't going to happen, or he's bluffing. People don't understand that he needs the tax revenue this time around.
Yeah, I mean, you've been pointing this out for a while. Our DC contacts have been saying that because the team wasn't in place, it was most likely that we would start to get, tariffs from April 1st of this year. But really, the market runs ahead of that. And so the market's traded as if we were going to get a ton of tariffs into the inauguration. And then, the dollar rallied, bonds sold off. And then what's happened subsequent to that is when Trump talks about these delays to April 1st, the market there's a relief, right? The dollar has fallen a bit, bonds have rallied back. People are feeling a bit more complacent that maybe, it won't actually happen. But to your point on the deficits and the budget process, it's such a tight margin now for Republicans, and there are about a dozen or so Freedom Caucus members that have never voted for a debt ceiling increase, and so it's just going to be harder to push through an agenda of aggressive tax cuts without commensurate spending cuts or tariff revenues to make up the difference. And so we know how hard it is to get those spending cuts in DC. Tariff revenues seem like a likely plug that is coming in a large way. And Trump just needed to get the team in place. He announced it yesterday, these reciprocal tariffs. They're going to do a lot of work over the course of the next 6 weeks. And then come April 1st, I really think, we're going to be hearing a lot more about tariffs. We're going to be thinking a lot more about that revenue coming in. It's going to create continue to create a lot of uncertainty. And I think that's where that stagflationary backdrop comes into play, right?
Yes, and you can see there K-Web outperforming the Qs, I think, over the last year and a half. And
you have this increasing inflation momentum, but outlook on the tariffs takes hold. Yeah, and that's a precarious situation. That's something that we're a little bit more.
And so I think on the one thing on the gold silver ratio, one thing clients are talking about, Jose, if you can show the gold silver ratio, we had a big break this week. Gold's premium to silver is, once you're in that 90 handle gold silver ratio, at this point in the cycle, a lot of clients on the institutional side are moving out of gold into silver. And as you can see here, we had a big break today where historically, when you get this kind of move, at the end of the day, the mothership, Craig, is gold and the tertiary metals follow. Is that kind of what you're hearing from clients? In other words, light and gold add to silver, platinum, palladium?
Yeah, I mean, gold's been the leader. We've been talking about it for quite some time. It's benefiting from a lot of structural trends about this reordering of global trade. It's disconnected from the move in real yields, and so it's been the horse. It's been the leader. But as we start to get a little bit more data out of China about stimulus, there was some big credit data out over I think overnight, with respect to China stimulus, and just some more talk about China, finding a floor in its economic momentum. And so as people get a little bit more excited about that China growth momentum, some of the capital can shift out of gold into other precious metals that are a little bit more industrial in use. Silver's clearly, kind of number one on that regard. Copper's been a beneficiary of that as well. And then there's always this talk about, where's the silver, the paper silver to gold silver ratio. The stocks are being depleted from various, we're not sure if that's the conspiracy theory stuff that's going on, but really it's a little bit more about the China growth momentum starting to come off the floor and this shift, out of gold specifically into other places to get a little bit more diversification in case that economic momentum from China starts to pick up.
Yeah, one thing clients are talking about is the reaction function. So one of the evil things about passive investing is when you go from 52, 53 up to above 60, 61, 62% passive versus active, all that means is that there's just more money flowing into some big names, the Walmarts of the world, these large cap equities. And so the reaction function is different now because there's so much what I call idiotic passive money. It's not active. It's more just a mad mob of people. And as you can see here, Walmart, you had retail sales today where they were really horrific. Walmart equity should have been off, 2-3% on this, right? Because it's very much exposed to retail sales. But for most of the morning, or even pre-market, Walmart was up to flat. And so the bigger what I'm hearing from Craig, from clients, is the bigger this passive component is, the more disgusting the reaction function is in the market. And these stocks become extremely extended. As you can see here, Walmart 32% above its 200-day moving average. Like since 2000, it's spent very little time up here. But that's how extended a lot of these names are.
Yeah, I mean, the right to your point. I mean, the percentage of capital that's actively managed, fundamentally based, that's looking at Walmart now is about as low as it's ever been, right? And so there's the other factors that drive Walmart's performance: passive flows, systematic flows, because it's a component of the S&P, because it's a component of the XLP, and so it's benefited from flows out of the RFK names, right? And it's done incredibly well because of that. So. But it has earnings coming up. I don't know if they're next week or the week after. And so that's typically when fundamental players will step back in and start thinking about the actual business fundamentals. And so it's typically at those turning points where we start to see these stretch relationships can kind of fall back in line as fundamental players, push the stocks back to some sort of quote unquote reality. But you're right. This passive flow dynamic is going to be with us, and it's just something we have to continue to be mindful of. And we can see stretch relationships versus history continue for longer than we can stay solid.
Yeah, this has been going on a long time, and this Walmart thing. One thing clients are talking about is the ICE raids are very aggressive, and Walmart, for example, has a lot of customers that potentially are undocumented, just on the customer side. And then there's talk about which companies, because of the ICE raids with migration, a lot of the labor force, a certain chunk of the labor force, is potentially now underground, not showing up for work, potentially very disruptive. And there are companies that are exposed to this. There are companies that are not exposed. But some people are mentioning Walmart as being a company that definitely is exposed to undocumented customers. Whether they're exposed to undocumented workers is another matter. What are you hearing on this, Craig, in terms of the bond rally this week? Bonds seem to be rallying on the rally in bonds is very different now than it was, say, a month ago. What are you hearing in terms of the slowdown?
Yeah, I think the bond market this week is starting to sniff out a bit of this growth deceleration, right? I mean, we saw earlier in the week on the CPI print coming in hotter than expected. Bonds did have a pretty good sell-off as we removed rate cuts, from the outlook, and really the whole curve kind of shifted higher in yield. But subsequent to that, with the PPI coming in a little bit softer, and certainly today with retail sales really, really disappointing. And even the industrial production numbers that were out were disappointing. The beat was only due to cold weather and utilities. I mean, auto production in January down 5% year on year. I mean, so there seems to be a growing concern in the bond market about growth momentum. Atlanta GDP.
Yeah, I mean, think of like how hot PPI and CPI were, and you get this kind of bond rally. I mean, that's very unusual. Like if this PPI number and CPI number had come out last month, bonds would have viciously sold off. Now we're rallying.
Right. Yeah, I think you have this stagflationary environment, right? It's not your 1970s stagflation where growth is slowing and inflation is 7, 8, 10%. It's though that inflation is sticky here, well above 2% and above where real wage growth is, and so an increasing segment of the population is continuing to fall into the lower branch of the K-shaped economy. Interest rates for them on credit cards, auto loans, mortgages are too high, and more of their wallet share is going to basic necessities.
And then this week we had some Capital One underperformed because of delinquency.
There was fourth quarter delinquencies hit a multi-quarter high. That was kind of across all types of loans, auto loans, credit card loans. So yeah, I think you're seeing that strain, moving into the vernacular here about the economy. And then when you add to that the uncertainty that the Trump policy regime is right now with respect to tariffs and the budget, I think more folks are thinking about sitting on their hands, hunkering down, waiting it out, as opposed to hiring, investing, spending. And I think that's going to, I think the bond market maybe is starting to pick up on some of that potential and the fiscal contraction that could come from a government spending cut. So I think that's coming. I think retail sales may have been the first shot across the bow on that reality.
And two different clients mentioned this week the divergence between the Mag 7 is spectacular. In other words, in a bull market, say 2013, 2023, 2024. the Mag 7 pretty much all, 7 or 8 stocks of them, they pretty much all went up together. Now we're seeing, NVIDIA underperform Meta, we're seeing massive outperformance of Meta versus the Qs, Meta versus Microsoft. And so for the first time, we're seeing kind of a chink in the armor where, what are clients talking about here, Craig? Like, you've got this kind of divergence between the different leadership in the market, and this kind of divergence wasn't there before.
Yeah, look, I mean, I think we've been pointing out just this chop zone that we've seen in NASDAQ, which is obviously, I forget the number, 45% is amongst the Mag 7 names. And we've just seen that chopping. And so there's been that, rotations are going on, and folks are wondering, like, are we in that topping process, right? We talked about this, markets kind of go through a topping process, a digestion process, and are they going to digest here and kind of resume their upward trajectory? I mean, or are they going to kind of roll over? And so,
yeah, they're like, everybody's moving from the craps table to the roulette table. In other words, NVIDIA was the darling, and now it's back to Meta. And then it's just like, whereas in 2023, 24, they were all kind of going up together.
Right. And so the question from here is, what could take the mantle, if we keep losing these, these stools of the Mag 7, will it be semis? Will it be other software names? Are they going to shift to industrials? Are they going to shift to, and banks have done, incredibly well. I think that's been an area people have felt very comfortable with. I mean, there's been a lot of talk about deregulation in the banking sector. Powell was on the Hill this week talking about the SLR reform, which has helped swap spreads.
And remember, what's SLR is like yours.
The supplemental leverage ratio. Basically, it's just the ability of banks to not get charged for the treasuries that they own on their balance sheet. Kind of frees up their balance sheet then to do other lending, other fee generating type business, other spread business for them. So it's been and Treasury needs it. That needs the banks, to support the Treasury market as foreigners are, net selling treasuries. And so Powell was out saying, he really thinks this is a necessity, should happen, sooner rather than later. So I think banks have reacted positively to that dynamic.
Well, great to catch up. And, we really appreciate everybody joining. We want to keep it to like 15 to 17 minutes every week. Big divergence within the Mag 7, gold, silver making a move versus gold this week. Massive extension in some of these names like Walmart. Credit's been strong overall in the market, but there are parts of the market that are really starting to underperform, and some of the divergences are picking up.
Yeah.
But thanks a lot, Craig. We'll catch you next week.